Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Markets tumble amid uncertainty. That's interesting. When exactly were they certain? Strong headwinds. It's weather terminology for our thesis met reality. Financial television is impressive. They can fill 6 hours explaining why something that happened was obvious. We're neutral on this stock. That's not analysis. That's Switzerland with a spreadsheet. Circle back is corporate for I hope this solves itself.
Globally, private capital is still chasing the future. AI and space. SpaceX is in trillion-dollar territory. OpenAI up triple digits. Investors are paying today for tomorrow's dominance. India's story is different. NSE's sharp jump signals rising financialization. Zerodha and Zoho show steady profitable growth. Less hype, more cash flows. One market is pricing disruption, the other is pricing participation. Both are powerful, just driven by different engines. Here's the twist in global macro. Strong US data used to mean a stronger dollar, not anymore. Rate expectations are drifting lower, the two-year forward differential is narrowing, and the trade-weighted dollar is sliding, even as gold rips to fresh highs. That's classic good news is bad news for the dollar behavior. Translation: markets may be shifting back to the old regime where strong growth fuels global risk appetite, capital flows outward, and the dollar weakens. If this sticks, it's a structural pivot and not just a bad day on the charts. Here's what most miss. At similar income levels, India is generating more solar per person than China did and far less coal. China's rise was coal heavy, India's path is increasingly sun power. Solar's share is scaling faster at comparable GDP per capita, while coal intensity remains structurally lower. In a world where cheap, reliable electricity decides industrial winners, from EVs to AI data centers, the edge goes to whoever builds clean capacity fastest. India may not replicate the China model, it might be rewriting it. Oil math isn't patriotic, it's arithmetic. Russian crude at around $469 a ton is still 7 to 12% cheaper than supplies from the US, Saudi, or the UAE. And with Russia accounting for roughly a third of India's imports, that discount matters. Swap it out, and the import bill could rise by $6 to $8 billion a year. That's not pocket change. That's pressure on fiscal math and possibly fuel prices. The import basket is clearly tilted towards price advantage over geopolitics. Because at $100 plus oil, ideology gets expensive. For years, advanced economies partied on low rates. Now the bill has arrived. Growth is slowing, populations are aging, and geopolitics isn't exactly calming nerves. The result? Even as policy rates edge lower, long-term bond yields stay stubbornly high. Markets are demanding a bigger risk premium for lending to governments, already carrying debt north of 100% of GDP in many cases. And rising pension and healthcare spending and fiscal deficits are set to widen again. Cheap money masks the problem. Expensive money exposes it. Dubai's transformation is hiding in plain sight. In the 1970s and early 80s, oil revenues were a massive share of GDP. Today, barely a rounding error. What replaced it? Trade, tourism, logistics, finance, real estate. A full-service global hub built on geography and ambition. Oil funded the runway, diversification built the airline. And that's not the real story. Not the resource wealth, but reinvested resource wealth. Dubai did not abandon oil, it used it as seed capital.